All right, all right, all right. Good morning, everybody. Good morning, John Walkup.
Oh, Noah Rosenblatt, good morning. It's good to see you through the screen.
It is good to see you on this rainy Monday. Nice to see you. Nice to see you guys. Let's rock and roll. Let's get this going. There's a lot to talk about. Good morning, everybody. Thank you for joining us. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and it is Monday. You know what that means. You guys are going to get a little dose of macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate. We're going to go into a bunch of macro topics on the top over there, and then we're going to end with Manhattan real estate. We'll try to do all of this in 30 minutes or less. Nothing on this show is financial advice. Do not start day trading this stuff. If you guys have any comments, please just put it right over there in the live comments. Johnny Walkup, you're going to keep an eye on those comments, right?
I'm going to try. I'm also going to try and work the banners and just some, housekeeping stuff. Today, we're trying to broadcast in the full HD power that this platform provides. We're going to be sharing the screen so Noah can draw on it because, everyone likes the X's and O's that he does. It's great. But again,
John Madden-style.
John, thank you. I couldn't remember that name off the top of my head, but yeah, John Madden-style. So, but again, we're very conscious of the quality. So if you see something that looks right, give us thumbs up. If it's still not off or it's still not looking good, please let us know. We'll keep tinkering until we get it right.
Yes, thank you, John. We're going back and forth on this new StreamYard thing, this YouTube live stream, and let us know how this looks. Let us know. We're gathering feedback so we can fine tune this thing, and then we'll pick a format and we'll go with it. Let's get started, guys. Let's get started. I am on the dashboard, show you guys where I am at. I am scrolling down. I am on the market snapshot section right over here. I want to start with my supply over the last 30 days. We're in a new month. We're in May. Okay, so the majority of this is going to be April, right? So this is not reflective of May, obviously. May is supposed to come in at 1544. Okay, 1544 is what the 30-day pace is supposed to be for May. We've had more supply come on in the last couple of months, Johnny Walkup. Okay, more supply in the last couple of months. We'll go into that, right? Yeah. But you're supposed to see a tick down for May. Okay.
Yeah, usually you see a tick down. I mean, look, it keeps building, and then at some point it just kind of crests and it starts declining, and you basically have that decline until you get to after Labor Day when it really spikes up again and then fades again. So that's the seasonal nature. So we're sort of riding the seasonal roller coaster right now.
Right. And May is like that transition month to that June, July, and August slower month. So it'll probably go down from here. We're approaching peak inventory. Give it another 3 weeks or so, and we should be at peak inventory or so. We'll keep an eye on that. Now, deal activity. It ticked down. Deal activity ticked down. We are supposed to close May at 1,123. May is the number 2 month behind only March. March and May are the two highest deal activity months. So 1123 is our target. We're at 950. We'll keep an eye on that. But April, okay, I want to show you guys something. I'm going to go to my chart room, okay? Monthly contract activity, okay? And I want to generate this chart, and we're going to go like 2 year. All right, guys. First off, let's just explain what we're looking at. Monthly deal activity is the blue, okay? Very simple. How many contracts were signed? The entire industry on a monthly basis. The orange is the average of where each month is supposed to be. So that's your guideline. And I just want to point out that we actually beat the average in April with everything going on, John. We had more deals signed than the average. 1,093 was where we came in. The average was 1,089. So it's not like it's a huge seller's market and we're just seeing a big pop, but we're above the average in a very uncertain month, John.
I know, and it's really interesting. Just to put this into context, it was last summer when we started noticing liquidity sort of bouncing around levels that it shouldn't normally be doing. It's kind of going sideways in summer. And sure enough, in the fall, we had, was it October, November, sort of, we're beating that seasonal average. And it's sort of like this market's coming back. Flash forward to January, February, March. We actually didn't get above that average. So it's like, okay, well, there's some deal volume. I understand maybe mortgage rates are higher. Maybe there's some other, things in the mix, but we're close. We're close. And then of all the months to beat it, it was April. And what's interesting is if you go back to the market ticker and you can look at those little bars that show that daily volume, right? I mean, the first week of April was quiet. Second week of April was a little bit better. Third week of April. And you think about it, it wasn't really great. And then just sort of all kind of came together at the end to squeak out a victory in terms of beating that seasonal average. and you think about all the things that I'm going to say the world, it was like the world against Manhattan in April, and Manhattan won. So it was pretty amazing because you had the stock market doing crazy things, the bond market doing crazy things, all kinds of announcements coming out that were making people rethink whether or not they should go shopping or not or what. But it's just like all this stuff got thrown at the market, and we still beat that seasonal average, which to me is a really bullish sign for this market. It's surprisingly
it's a
bullish.
resilient. Yeah, it's a sign of relative strength. I could see the deals, 150 deals signed in the last 3 days of April to close it out. Right there, you can see it. So that's what John's talking about. So I just want to point out, though, yes, it's relatively strong because April was so weak and uncertain and so much volatility. But at its core, we are at the average. We are at the average. So it's not like you're at some crazy high place. I do want to point out the climate index, guys. I like to point this out because this is one of those very contextual charts that you could really describe the listing environment for your sellers. For those of you that do not know, that green line at the top, that is our easy listing market. The blue line at the bottom, that is our challenging listing market. And I do want to point out, even with April, coming in slightly above the average, which was surprisingly strong, right? The listing climate deteriorated in April. Okay, we had to wait for this chart to get in. So it is a tougher relative than March. Relative than March, it is a more challenging listing environment, just like all of us probably thought. So sellers, you got to be aware of this change in the listing and temperature because, you only got one more month. You only got May. Once you get to June, you're transitioning to that slower summer. So we got to hope for a little pushback right over here. Do your business. Take your actions, do your price cuts, get your stuff done because, again, it's not as hot as it was in March.
Yeah, okay? And if any of you guys tuned into the session we had last Tuesday, we talked about shifting markets. Noah and I kind of had a bet on this chart. I actually thought it'd be a little bit higher, maybe even above that green line. Noah won, it was below. But it really kind of speaks to, and I'm really, to be honest, as much as I think it was a bullish sign that April activity was above the seasonal average, given everything that was thrown at it, right? To your point, it is just average. But again, just such a crazy environment to be at average was astounding. But absolutely, Noah, you were totally right, which is that it's still it's a more difficult market than March was. And I think that's what's making it very confusing for me to sort of understand that this whole mindset shift, because I get the sense that buyers are back, but I also get the sense that they're not back. They're just not like scrambling for deals just yet. They're interested in buying, but it's not the craziness that we've seen in, like 2022, 2015, these kind of things where you put something on the market and it's just gone.
Okay. I agree with that. And speaking of that point, I find myself having more and more conversations with agents reaching out, talking to me, talking about how the market, let me get that off, talking about how the market was like in 2015, 2014, 2013 versus today, because price action from 2014 and 15 is right about where we are now. But this chart is so different. So I encourage you guys to get great at this chart, especially when you're talking to a client who bought in a previous time. What was the listing temperature back in 2015 and what is it today? And what are the differences, right? Because you're not going to see it in price action. You're not going to see it in price action. Let's move on. Okay, guys, credit spreads. Credit spreads. This is our guide towards risk on, risk off in the market. It is the spread between corporate high yield bonds and investment grade bonds on the top, 10-year treasury yield bonds on the bottom, and it's always narrowing and widening. Bottom line is, let me just click on the max, all right, and you'll see what I'm talking about. Bottom line is, as credit spreads rise, look at the time, this is the great financial crisis, disarray comes in, right? Risk off, stock market goes down, et cetera, et cetera. So we just had a big bump over the course of April. You could see it right there. The credit spreads bumped, but it has come in over the last couple of weeks. And with that, stocks have quietly kind of recovered everything. So like, we have to ask ourselves, is it over? Are we done? Is this whole tariff thing done? I mean, I don't think it's done. I mean, credit spreads are still kind of a little higher than they were, but they're going the right direction. I don't think anyone believes it, John. Like, I don't think anyone could have believed that we would have recovered this whole thing at this point.
I don't think, well, look, if flash back to, was it April 7th, April 8th, and when the market was basically in free fall, we were down like 15%. I mean, everything looked
Yeah.
like, oh my goodness sakes, we could go down another 10, 15% at the drop of a hat. Because you look at what the S&P had done over the last decade or so. It's like you can understand how there could be plenty of room on the downside. And with all the announcements coming, with all the uncertainty, it seemed pretty much certain that, all right, there's probably more downside than upside here. And yet here we are, early May. It's like almost that whole period just didn't exist. The markets have kind of recovered. But I think this tells the more interesting story, which is uncertainty flashes in and is kind of weaned off a little bit, but it is not back to the levels that we saw in February, early March. It's still not there yet. And I think that sort of speaks to the idea that a little bit of hedging, right? So we're certainly not out of the woods yet in terms of uncertainty, but we're not at peak uncertainty, kind of like we were, I suppose, in early April.
Yes.
It was just sort of, we don't know what's going on.
That's what I circled right there. That's peak uncertainty.
Yeah,
right
that period. And I think we've kind of pulled back. And I think the picture here that I would understand is the credit markets are kind of hedging their bets, sort of. They're not ready to sort of capitulate and sort of bring spreads down narrow. They're still keeping a little bit of risk keeping their eye on risk and elevating the spreads just a little bit. So it's not out of the woods yet, but certainly it's a little bit, it can breathe a little bit easier, I suppose.
Here's what you guys need to know. This is going the right direction. Uncertainty is fading. Peak fear and peak uncertainty is past us, guys. Just that's what you need to know. Like, the market today is not as fearful or panicked as it was 3 weeks ago. That's it. Whether or not it's the market pricing in things, or I don't know, betting on that this is going to end sooner than later, kind of thing. Like, as time goes on, we're reaching the end of this. I don't know, but the bottom line is peak fear and peak uncertainty was that little circle right over there, first couple of weeks of April, and that's now going the other way. It's kind of what we want. Credit spreads at that time, right? At that time, reached 2.4, right? 2.4 or 2.5, John?
They got to 2.4, that marker.
2.4. So now we went back down. Now we're at 2.2. So that's reflecting this going down, and that's good. That's why stocks are risk on a little bit right now. Where we go from here, we got to keep an eye on this again. In the whole scheme of things, right? If I just bounce back to max of this chart, look at where we are on the right side, guys. John, you made this point. We're still relatively low. So yeah, we saw some uncertainty, but it never followed through. The depth, the duration of it never followed through. It came kind of right back. And you always got to keep that in mind with these things, with the credit market.
Yeah, this is one of those events where, just to paraphrase, Kennedy, this is, the only thing to fear is fear itself, kind of thing. And that the idea is that you look at what happened in 2008, it's a sharp spike up. And if you look at what happened now, right, even in COVID, sharp spike up, instantaneous fear, instantaneous uncertainty. Same here, but we didn't necessarily have the physical effects of that piling on yet. So in 2008, right, you had all this uncertainty because there's essentially a liquidity crisis. Like the banks stopped lending money, and the banks refused to lend it even to themselves. So that was a huge crunch, and that pushed spreads straight up. 2020, same kind of thing. We had, I don't know if you remember, there's this thing called, I think it was called COVID or something like that. Anyway, it scared people, and it was out there, and we all had to wear masks. It was a weird time. And it froze the markets a little bit, right? The real estate, think about it, the market was closed, nothing to do. So that pushed spiked it up exponentially straight. Here, we're certainly up, but we haven't had that actual follow through yet of the actual stuff that might be coming from this whole tariff talks. So you think about the way these things work. And what I want to point out too is, if you look at 2022, you look at how they rose from almost record lows and they just slowly, steadily marched higher. I think that's what we have coming toward us. So we've worked our way up quickly. We kind of stair-stepped our way back down. And I think as we start to see the effects of April's talk come into fruition, we might start stair-stepping our way back up as these things sort of make their way through the system. So I don't think we're out of the woods just yet. I think the credit spreads have come down a little bit. Certainly, like I said, a little bit of breathing room. But I think looking forward, I think we're not out of the woods yet. I think we're going to see a little bit stair-step higher, working.
Okay, so we got to be cautious. We got to be cautious. I was reading, I don't know if it was Lance Lambert or someone on Twitter was going over interviews with builders like D.R. Horton and those kind of big builders, and they were asking about tariffs. And one of the builders said, "We don't see anything now. We don't see anything next quarter, but we do expect to see something in the fourth quarter of this year." Fourth quarter. The other builders said, we don't see anything now. We don't see anything next quarter. We don't see anything this year, but we do expect the tariff uncertainty and the tariff rise to hit in the first quarter of next year. So you got two builders, both of which saying, one of them saying Q4 and one of them saying Q1 of next year. So again, it puts a little credence to what you're saying over here. All this tariff stuff that's going on is not a now thing. That will show up at a later point in time. And according to these builders, Q4 and Q1. So you got time. You got time before that hits. So we'll have to deal with that at that time. We'll keep an eye on that. Okay. Bottom line, credit spreads are improving, guys. Can't deny it. It's going back. It's going down. Okay. It's going down. It's not as nearly as high as it was. So a little risk on the markets. We'll see where that goes. Now let's go to Fed and let's go to rates, guys. Let's go to rates. Fed watch. By the way, with credit spreads, we have a new Fed here. I don't know if the Fed's going to allow a credit event like Lehman Brothers again. I really don't. There's a whole new playbook. We talked about this in the past. They brought it out in COVID. Like you saw it in COVID. That's why in this max chart, the credit spreads right here, it didn't go as high as the great financial crisis. They stopped it basically. So it's my opinion that when something does happen here, the Fed's going to do something drastic. We'll see. Well, hopefully that doesn't happen, but when it does, we'll watch it. This is the Fed watch, guys. This is rates, CME group. I'm in the probabilities table. Okay, let's go take a look at what's going on. There were changes. There were changes that you need to know. First off, that whole June cut that we were talking about is now gone right there. It's down to 30%, 70% of a pause now in June. Okay, this is while stocks have been rising, John.
Right. Well, we had the job number come out on Friday, and it seemed like a stronger number than expected. And just, if you take aside the markets and you're not focused on the market, and you're just focused on the economy, things are still looking okay. And I think the Fed fund future market looked at that and they're like, well, if the economy's doing okay, why would the Fed be cutting rates here? Why wouldn't they hold that ammunition until the economy is really looking bad or is on the precipice of looking bad? And I think what was interesting is I think when we looked at this Fed fund futures last time for the rate cut in June, I think we were at 62%, something like that.
Yeah, this one
and
right
we had
here,
talked about how it had gone down to like 54%, worked its way up. Like sometimes this is also like watching grass grow. But hey, this is again, someone took the weed whacker to the June cut, and just now it's just not even on the table. So it's interesting how just a couple of data points, right? That data dependent Fed, a couple of data points that pointing in the right direction for the economy completely remove that cut from the table. Now, it could still come back. That's true. But for right now, it's maybe July, and even July is sort of,
iffy, 54%. So let's go over it, guys. We are here. The next Fed meeting is May 7th. There is a 99% chance that there is no move. That's what we call a pause. In June, same thing. Now, 70% of no move. That's the change. That's the change, guys, from last week. The markets are now changing their expectations. This is how rates move without the Fed doing anything. Okay, it's the market. The market's changing. The first cut is now expected to be July, but as John mentioned, you're at 54.5%. There's also 26% chance they pause and don't do anything there as well. Right? 19% chance of this guy, but that's on the low end. So right now, first cut July, second cut September, but you're starting to get into lower percentages. You got a pause in October and then a cut in December. So you got 1, 2, 3 cuts. Okay. 1, 2, 3 cuts this year, July and September and December, as opposed to 4 cuts last week. They're pushing it back.
And one of the things we've watched over the course of the last 6 months is this. We started out, back in December. I mean, it was basically a straight line down. Like there was no expectation for the Fed to do anything. It slowly shifted to the cuts. I think we had a couple people who were betting on like 2%, 1.5%, like ultra low rates by the end of 2026, early 2027. And now everything's kind of shifted back toward the center. So maybe a couple cuts, in the next 8 to 10 months, but nothing extraordinary. And I think the Fed's they're really in between a rock and a hard place because they're trying to balance the economy. They're trying to balance jobs. And I think anyone is thinking there's huge inflation coming down the pike in terms of, what may or may not be a tariff. So, if the tariffs do hit and you see prices start rising, does the Fed cut into that? I mean, I think their hands are effectively tied either way. So it's this, they're on a thin margin here.
Yeah, it's almost like the chances of this thing moving to the right are higher than it moving to the left, kind of a thing. But we'll see. This is what we use to figure out where rates are going to go and what the market's expecting, guys. We're not supposed to know anything more than the market. Well, and this is the market. That's what you guys need to know. Let's not try to complicate things. Let's not try to simplify things, guys. We are not in the prediction game. When you talk to clients, don't predict. The verbiage is this. Hey, when I look at the Fed fund futures, okay, well, right there, Fed fund futures, what I do? Fed fund futures, the market expects. That's the verbiage. That's how you talk to your clients, your Wall Street guys. When I look at the Fed fund futures, the market expects 1 cut in July, 1 cut in September, 1 cut in December, but these are low percentages. And you know what? They were expecting 4 cuts last week. Now they only got 3 cuts. Just reporting the facts. Yeah. And hopefully you guys could do this on your own. Okay.
Right. And I think the biggest point is that, we talk about, we're getting to mortgage rates now. Let me put the banner up there. Mortgage rates. Here we go. But we're talking about how Fed fund futures, how do they influence mortgage rates? Why do we even talk about it? Right. Usually mortgages are priced off of the 10-year. So why bother with the Fed fund futures? Well, because that shifting nature of them sort of dictates which way rates are going to go. And we've kind of seen everything slowly move to the right, not exponentially in terms of rate hikes, but they've kind of firmed up, and it basically suggests that the low rates that people are expecting aren't really going to show up. And so that's why when you go to mortgage rates and you actually kind of look at that, what that curve looks like over the last, month or so, it's basically going sideways, a little bit tick up, a little bit. I'm looking at the fixed. I tend to look at the fixed because the jumbo, that light blue one, looks a little spiky, but fixed rates are basically
you're looking at
sideways.
The dark blue one. The dark.
I'm sorry, the dark blue one. The light blue one's the jumbo. It's sort of very spiky because it's a different beast. But mortgage rates essentially are sort of stuck around. Was that 6 3/4 or so, 6.5? And this is obviously your mileage is going to vary if you've got a high credit score. If you got a definitely a different loan to value ratios, you could definitely see some different rates. But in general, that main force of mortgage rates is essentially moving sideways. And if anything, it's starting to tick up just again. So got that going for us.
Yeah. So you're right. So mortgage rates are ticking a little higher. That's what you need to know. And guys, we're look at the left here. Look at the left side of the chart. Look at 6.5% and look at 7%. Look at that channel. 7% at the top, 6.5%. Now go to the right. We're basically trading in between 6.5% and 7% for the last 6 months. Okay. I feel like we're a little bit on the high side for the jumbos, and we are a jumbo city. So mortgage rates just under 7%, ticking a little higher for your buyers. Now, I want to move to national real estate a little bit, guys. There's a point to all of this that we'll circle back with in Manhattan. Bottom line is new listing activity on a national basis and for UrbanDigs, for Manhattan, they're rising. Take a look at the black bars on this chart, guys. Okay, this is U.S. national real estate. This is not Manhattan. U.S. national real estate. For the longest time, we had low inventory, and the argument for that was there's no sellers. There's no sellers at the margin. Why? Because they're all locked in. There's a lock-in, mortgage lock-in effect. If I got 2%, 3%, 4% mortgages, I ain't going anywhere. And that's for the most part true. But as time goes on, that lock-in effect fades ever so slowly, and more listings might get unlocked to list. Well, when I look at the national housing market, look at those black bars, okay? 4 months straight of pretty good growth for new listing activity across the nation, John. Not in the Northeast.
That's true. So we can look at a map and we kind of can see where it's going. But what the interesting thing to think about is, and we've said it before, that most of the home sellers out there are also home buyers. So seeing this listing increase, to me, that's a prelude to seeing a market sort of, get back going. Now, obviously, you can have some,
more transaction volume, more transaction volume.
More transaction volumes. Obviously, you're going to have some supply and demand dynamics come in, right? You might have more supply pushing down prices, especially in markets like Florida and Texas, which saw an incredible run up, post-pandemic. I think you see supply now, it's going to press prices down. But that's kind of what we're seeing in our market. So thank you for bringing up Manhattan, right? So this is just a monthly listing, month over month. And you can see that light blue is 2025. And we're starting to sort of make our way higher in terms of that monthly new supply.
Yeah, less so in Manhattan than in the national. Less so in Manhattan, right? Manhattan's starting to get some blue. This is Manhattan right here. Starting to get some blue kick up a little bit, but we're still relatively low. And you know what? Let's just stay on the supply thing for a second. Over the last, everyone likes to compare pre-pandemic to today. This is one of those national housing charts that's looking at inventory across the country from pre-pandemic to today. Look at the Northeast. Look at the Northeast. Guys, I'm trying to give you ammunition. You guys are talking to investors. You're talking to buyers all the time. This is more on the buy side and investor side to differentiate our market and what's going on in our sector. We're just structurally seeing a different housing dynamic in our region than across the country. And you guys could take screenshots of this, pull it out when you want to, remind them where they are. When I look at Manhattan supply since April 2019 to today, we're down about 11%. We're down about 11%. We're not down 66%, but we're down about 11%. Okay? But still, it's the bigger picture. There's a structural difference going on in the Northeast sector than that's going on in the rest of the country. John, any thoughts on this real quick?
Well, no, but I think the supply and demand dynamics that exist in Manhattan as well as in Brooklyn, we're starting to finally see supply come on in Brooklyn a little bit above where we've seen it in 23, 24. We just don't have time to really put everything on the screen. It's going to look. You're right. I think there's, just to go back to the very beginning, and we talked about April's deal volume and where May is, and just trying to think of that liquidity number. Like, I do get the sense, and even though the climate index is down, I do get the sense that there is a growing demand for Manhattan and Brooklyn properties. I think that bid is slowly starting to come back. And that's what we think we saw in April, but back at the seasonal level. And I'm hoping we can get there for May too, because I just get the sense, and we're going to do an interesting webinar with a guy named Noah. What's his last name? I feel bad. I forgot his last name. Noam Newman. That'll be on Thursday, May 12th, I believe. Right. And the idea
Thursday, space something.
Right. And the idea is that this is actually a very interesting time for Manhattan real estate, especially if you think about what's coming down and what the alternatives are. It might be a very interesting time for buyers.
Well, I'll tell you one thing, and we're going to circle this back to Manhattan real estate. That Noam Newman is going to be Thursday, May 15th. Sorry. That's going to be why New York City is still a good place to invest kind of thing. We're going to circle back to how this all affects Manhattan real estate right now. Guys, take a look at the median age of U.S. home buyers. Take a look at this. And let's think about this for a second. Look at the yellow. That's repeat home buyers up to 61 years old. It was 46 years old in the great financial crisis. It's up to 61. Look at all home buyers up to 56. That was at around 39 in the great financial crisis, 56. First-time home buyers, 38. They can't afford them. They can't afford them, right? They can't afford them. That's like, if the age is going up for all these different buyers, it's got to be an affordability thing. Where do they go? They're renting. They're renting. And the thesis of the Noam Newman talk next Thursday is that the rental market in New York City is about to go parabolic. You guys got to join this talk. I got on a call with Noam a few days ago, and he started ranting. And I'm like, holy shit, we got to go a webinar on this. And that's why that's going up on the calendar. And he was explaining to me, he has a bunch of rental properties. He's like, no, the rent increases that are coming in right now are starting a parabolic increase. And we just reported on Friday, look at April's rental numbers. Popped to $4,795, I believe.
Right. Almost 4,800 after breaking that 4,500 mark for the longest time. It broke it in March, and then boom, right up to almost 4,800.
And he's claiming this is just the beginning, that we're about to see a shift. That's going to change the dynamics. That's going to bring in residential development for rentals. Then it's going to boost the sales market. Then that's going to bring in residential developers for sales. And he's got all these theses here. And he says it stems from the 2019 rent regulations. It's an unintended consequence of the 2019 that put us into this. It took us 6 years to get to this spot, and he's going to explain it on Thursday. It's a really fascinating concept, and it goes to the whole bottom line that New York City is about to have a big run-up. It's about to have a big run-up. I don't know if it's going to come true. I would love for you guys to join in. We'll get some debates going on, but that's how it circles back in these rental costs, right? There's some structural things going on. Very, very interesting conversation when we talk about supply, demand, rents, climate index, all these different things, put it all together, credit spreads, this environment. So many things happening right now. I can imagine how confused people are. We got to try to just tone it all down and come up with the right talking points. And that's what we're going to try to do. It's not on the calendar yet for Thursday, May 15th, but that'll get put up. Okay.
Right.
for Noam.
Yeah. So my biggest takeaway from the rental market is this is going to be all signs indicate to a very, very tight rental market for the summer, right? So demand is leading supply, and prices are starting to go at record highs, and we're not even in. We're just beginning May right now, so we've got May, June, July ahead of us. These are the busier months, and ouch.
Have
if you're a renter
you
trying to renew.
seen the Real Deal article about commercial sector, John?
No, I embarrassingly do not have a Real Deal subscription, so
I sent it to
I
you.
haven't
I
seen
think.
it.
The commercial sector is starting to really heat up a little bit. There's a bunch of big signings going on. It's having some solid growth continuously. The commercial sector in Manhattan is starting to go to another recovery level as the rental market still. How does this affect buy side decisions? What are renters saying to this? At what point does a sale look like a better potential move? Especially when considering, let's go to the chart room real quick, guys. Look at that price action chart. We started off saying that price action is basically nowhere in the last 10 years. This is what I'm talking about. This chart, price per square foot, resale condo, max. Look at this. It's nowhere. Even that's starting to bump up a little bit on the data. Suppressed. A suppressed market. I think, John, I think you're right into a lot of live chat comments there, I guess, right?
I am. Can you hear that's clicking? That's interesting. I'm replying. Someone's asking, who's talking? So I replied back.
Yeah. I mean, national housing market's up 100% since then. We're flat. Okay. There is relative value in this market, right as rental market's starting to really go up, right as April surprisingly had deal activity over the average, right as the climate index deteriorated for sales. A very confusing situation going on here. A lot of conflicting signals going on right here, but there's relative value in this market. So it's going to be really interesting to see how all this plays out, guys. We'll do all that on the show. Okay. Yeah. Any final questions or no?
Yes. There's people want to know about the webinar. What time is that on Thursday? I think it's
that's going to be 1 o'clock. Yeah, we didn't. I'm coming up with one of these little things. Let me give you a couple plugs. First off, tomorrow we'll be here doing outdoor space. This is a very lively session, guys. Valuing terraces, valuing balconies. We'll go over the UrbanDigs model. We'll go over the Jonathan Miller model that he did when we did a seminar. We'll do all that for you tomorrow. Thursday, I got Jared Anton here, going to talk about business growth, controlling the funnel, converting clients, all that kind of stuff. He's a smart guy. Thursday, May 15th will be that Noam Newman thing. It's not on the calendar yet, but that's the one you're going to want to talk about and join. It's going to be really interesting, that webinar. Okay. We'll try to get Jonathan Miller back on. By the way, Jonathan Miller was supposed to join us last Monday. He canceled last minute. That's why he wasn't on. We'll try to get Jonathan Miller back on as well.
Yeah. Now it's my turn to do a couple plugs. So I just want to say, if you go to the Market Intelligence, we put out a piece called Chart Grades Are In. So we basically reviewed April's performance. So if you want to have something either maybe sent to your clients or just kind of review what April's performance looked like in context, that's a great piece there. And also I just like to plug our service, UrbanDigs Advisor. I don't know how many of you know it. This is a real salesy plug for me, which I don't normally like, but hey, we provide a pricing service. So
you are a broker, though.
I know, but we do this with sort of a neutral third party, interesting source of data and insight for buyers and sellers, to help them make decisions faster.
Well, I'll tell you this: we partnered with an appraiser. We now offer these reports with a virtual appraisal, and you guys should hear about this. We're going to start a marketing campaign on this and put some investment into the service. If you ever find yourself in a bind, we can help you with data and we can help you with property reports with an appraiser. Okay. That's it. Shameless plug. Thank you, John. But guys, I hope this was interesting. I hope this cleared up a couple of talking points for you guys, especially when it comes to rates and when it comes to our rental market and when it comes to the median age of buyers and the structural differences. It all starts to kind of make sense what's going on here. And I don't know, in my eyes, all this data leads to potentially an overperforming New York City market after a very underperforming decade. So it's
yeah, and honestly, times. I did not think we would be in this position 4 weeks ago.
You see?
So
we got to be careful. These things could fade. We'll see where we are. We're not out of the woods, but we're certainly in a better place than just 3 weeks ago. All right. Thank you, John Walkup, for everything you do. I am Noah Rosenblatt. This has been Macro Monday. Thank you guys for joining. Hopefully I see you tomorrow and on future events. Otherwise, take care. We'll see you next time.
Thanks, Cheers, everybody.